Thank you for downloading this recording, Advanced Financial Reporting or SBR. Today I want to focus on financial instruments, and then later on we should be able to also share something on share-based payments. Perhaps financial instruments and share-based payments makes one of your complex parts in your syllabus, but I think that it's very important for us to appreciate the principles that lies behind these two topics. So I'd like to also say, as you can see on your screen there, that this topic of financial instruments involves about 3 standards. We have got IS 32, which deals with presentation, IFRS 9, measurement, IFRS 7, disclosures. You can read the learning objectives at your own time. Let me get on to the heart of the matter. Why financial instruments? Well, financial markets across the world are now using sophisticated financial securities which normally have material effects on the financial statements. Now, when you look at what has been happening rather in the recent past, is that most entities have been treating financial instruments as off-balance sheet items, which is not supposed to be the case because these have got material effects on the financial statements. Remember, the goal of standards again is to make financial statements to be more reliable and less misleading, if I can just use that. Classification IS 32. Crudely, we have 4 broad categories of financial instruments. Number 1, you have got financial assets, you have got financial liabilities, you have got equity instruments, and then you have got compound instruments, which is a hybrid of equity and liability instruments. Now, let's go through one by one, try to discuss briefly what these means. Let us start with a financial instrument. What is a financial instrument? This is a contract or agreement that gives rise to both a financial asset of one entity and a financial liability of another entity. Okay, now liability has been put side by side with equity because what we know is that equity is a special type of liability which represents, the interest of the beneficial owners of the company. All right, now let us progress. We have got a financial asset. What is it? A financial asset is any asset that is, number 1, cash, and number 2, an equity instrument of another entity. In other words, you could have bought some shares in another entity. And then C says the contractual right to receive cash or another financial asset from another entity, or indeed to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable. Examples of financial assets include trade receivables, options, shares as an investment. What do we have? We also have financial liability. What is it? Financial liability is one that gives rise to a contractual obligation, number 1, to deliver cash or another financial asset to another entity, number 2, to exchange financial assets or financial liabilities with another entity under favorable conditions. Then B says a contract that will or may be settled in an entity's own equity instruments. Examples of financial liabilities include trade payables, debenture loans, which is simply a written acknowledgement of borrowed funds, mandatorily redeemable preference shares, as well as forward contracts standing at a loss. Now, of course, when you talk about forward contracts, this is what you fascinated with in financial management. All right. I'd like us to progress to equity instrument. Equity instrument refers to any contract that evidences the residual interest in the assets of an entity after deducting all of its liabilities. Again, examples there include an entity's ordinary shares, warrants, non-cumulative, irredeemable preference shares. Then we have also what we call derivative. A derivative has 3 characteristics. Number 1, its value changes in response to an underlying variable, and it requires no initial net investment, and it is settled at the future date. Now, derivatives are simply financial instruments that have their value influenced or determined by an underlying financial instrument, an underlying variable, like the way we have seen in our screen. The examples include foreign currency forward contracts, interest rate swaps, as well as options. Now let us get on to the practical aspects of our discussion. We want to focus on redeemable preference shares as our starting point. All right. Number one, many entities issue preference shares which may be redeemed by the issuer for a fixed amount at a fixed future date. This means that the redeemable preference share can be treated as debt. Why? Because this is a clear characteristic of a debt instrument. In such cases, the issuer has a contractual obligation to deliver cash. Therefore, the instrument is a financial liability and should be classified as a liability in the statement of financial position. Let us look at an illustration to take the point home. Illustration 1, and this is just revision. Many entities issue preference shares which must be redeemed by the issuer for a fixed amount at a fixed future date. In such cases, the issuer has a contractual obligation to deliver cash. Therefore, the instrument is a financial liability and should be classified as a liability in the statement of financial position. All right, let us move on to another discussion. We have got what we call convertible loans or compound instruments, where a financial instrument retains some characteristics of equity and some of financial liability, then its separate components need to be classified separately. A common example is a convertible debt or convertible loan. We also have what we call convertible bonds. So we're going to practice a question or an illustration, and again, this is revision from your previous class. Let us go to that illustration. It says compound instruments. KSA issues 1,000 convertible bonds on 1st January X1 at par. Each bond is redeemable in 3 years' time at its par value of 2,000 per bond. Alternatively, each bond can be converted at the maturity date into 125 $1 shares. The bonds pay interest per year in arrears at an interest rate of 6%. All right, that is a reduced rate for the reason that there is an option to convert, and therefore these instruments carry lower risk. The prevailing market interest rate for 3-year bonds that have no right of conversion is 9% required. Show the presentation of the compound instrument in the financial statements at inception. Simple, at inception. The 3-year discount factors have been used. Now, what you need to know is that when we are doing the discounting, we are going to use these amounts, all right? The 6% will only be used to establish what we call the coupon rate, the amount of interest that will be payable to the holders of this financial instrument over the 3-year period. Let us now get on to the the work. All right, so what are we required to do? We're required to split the financial instrument into what we call equity. All right, of course this is a 6% convertible bonds. All right, and also we're supposed to have another component which depicts this instrument as a liability. And the non-current liabilities, again, I'll take that one and I'll push it where it belongs. And then afterwards, I'm going to do some bit of working for us. Let us do the separation and then we shall show the working there. Remember that we need to So we have got what we call extracts, of course, to the FS. Split the instruments, please. All right, into two components, just what I've showed you there. Let us now progress to the working. All right, so under splitting the instrument, what you do is you say, I want to establish the present value of future cash flows that fall under these particular instruments. So whenever we have got a liability, of course, we are likely to pay the principal, and also we are likely to pay interests. All right, so let me just write that one. 1,000 bonds multiplied by 2,000, that's the face value of one bond. Then further multiply that by 0. That is the simple interest, simple PV. Remember what we had on the other side, as this is the amount. All right, that's the discount factor there. That's the one that we're going to use. All right, let me just try to do some calculations here. 1,000 multiplied by 2,000, that is 2 million, of course. And then you multiply by the simple discount factor, you get that figure. All right, and then we go down, we say we also have to discount our interest. So we are dealing with 2 million already. I hope you remember where the 2 million is coming from. And I multiply that by 6%. I'll just write that one for you. And then we use now the cumulative discount factor for year 3 again, which was given, which is 2.531. I hope that you can see that. 2.531. Again, we do some works. What do we have? I'd like to just do this one. That's what we have there. The next thing is to find the total of these amounts as per our tradition. The total discount factor for these cash outflows will be that. But notice that today we are receiving how much? The now value of this instrument is 2 million, assuming there are no issue costs. So we say, what will be the balancing figure? That balancing figure is an increase in our equity. So we do the work, we say that is equal to minus that much. So that's what I have there. All right, so we've done the split. Not very difficult. So when we come up here, how much will be our equity component? It will be this same balancing figure that we found, which is that amount there. All right, and then next, when we come there, what will be our at inception, please? That will be the figure there. So let me just show you that. When you add these two amounts, you should be getting a 2,000. So what is happening really here is that your equity is being credited and your liability there is also being credited, but your bank is being debited with that amount. I hope that is clear. All right, thank you. Let us progress to something else. Treasury shares, if I could get there. If an entity reacquires its own equity instruments, the amount paid is presented as a deduction from equity rather than as an asset. All right, for an investment by the entity in itself, by acquiring its own shares, cannot be shown as an asset. No gain or loss is recognized. An illustration again here will do. Let us go to our work. All right. Illustration 3, Treasury bills. An entity acquired 10,000 of its own $1 shares, which had previously been issued at $1.50 each for $1.80 each. All right. So the entity is undecided as to whether to cancel the shares or reissue them at a later date. You are required to discuss how to treat the treasury shares above in the FS. Again, not as difficult as that looks. Let us deal with that as the working. Again, we are dealing with what we call treasury shares, which I think in my own words is redeemed shares. Okay. Of course, to redeem is to buy back. Let us try to, could this be a strategy of reducing future dividend payments? That could be your argument, of course, in your exams. I'm going to give you just an equity picture here. Picture of equity. Equity simply means capital plus reserve. So we have got share capital. All right. I'm just giving you some picture of some kind here. And then we've got share premium. All right. I give you again X. And then we are told that if we have got treasury shares, what are we to do? We're supposed to less that. So 1.8 multiplied by 10,000 shares, you should be getting minus 18,000. That's what you have there. All right. That's how you treat that. If the shares are cancelled, the 1.5 will be debited. $1.5 will be debited to share capital as follows. $1 will reduce. We'll reduce our share capital by 10,000, which is simply 10,000 by $1, and then we shall reduce our share premium at 0.5 dollars, which is simply 5,000. All right, and the excess, since we are dealing with 1.8 of 30 cents, should be recognized in the retained earnings rather than the profit or loss as the transaction relates to company members. So this is how you deal with what we call treasury shares. I'd like us to move on to the issue of recognition. We are done with that treasury shares. Let us go to recognition. So under recognition, again, we're dealing with IFRS 9. Financial assets and liabilities are required to be recognized in the statement of financial position when the entity becomes a party to the contractual provision of the instruments. Derivatives are recognized in the financial statements at inception, even though there may have been no cash flow, and disclosures about them are made in accordance with what we call IFRS 7. Let us also deal with executory contracts. An executory contract is one under which neither party has performed or fulfilled their obligations. For example, an unfulfilled order for the purchase of goods where at the end of the reporting period, the goods have neither been delivered nor been paid for. Executory contracts are outside the scope of IFRS 9. There's an illustration that we need to look at just to drive this point home. All right, now look at that. A forward contract to purchase cocoa beans for use in making chocolate is an executory contract which is outside the scope of IFRS 9. The purchase is not accounted for until the cocoa beans is actually delivered. All right. Now let us turn to an assignment. This one is under derecognition. Now, how do we derecognize financial instruments? Nice question. The recognition is the removal of a previously recognized financial instrument from an entity's statement of financial position. The recognition happens when under financial assets, when the contractual rights to the cash flows expire, because, for instance, a customer has made payment. The financial asset is transferred based on whether the entity has transferred substantially all the risks and rewards of ownership of the financial asset. Now, this reminds me, of course, of IFRS 15, where you discuss the issues of transfer of risks. All right. The recognition of financial liability occurs when it is extinguished. Now, how do you extinguish a financial liability? By discharging your liability in full, all right, or by giving up, of course, another asset. All right. Assignment 1 is the next working that we need to look at. That is, we were going to discuss whether the following financial instruments would be derecognized. A says, AB sells an investment in shares but retains a call option to purchase those shares at any time at a price equal to their current market value at the date of purchase. Can we attend to that briefly? AB, this is the answer, please, and if you have got a pen, you can be writing. AB should recognize the asset as it only has the option rather than an obligation to purchase. AB should recognize the asset as it only has the option rather than an obligation to purchase. Then B says EF enters into an agreement. This is supposed to write an agreement where an investment is lent to a third party for a fixed period of time for a fee. At the end of the period of time, the investment is returned to EF. It seems as if rewards and risks have not been transferred here to the client. So EF should not recognize the asset as it retains substantially all the risks and rewards of ownership of the asset. The stock or the financial instrument should be retained in the books of the company, even if legal rights have been transferred. Remember, we account for business transactions according to the commercial reality rather than the legal view. I hope that that is clear. Let us progress to the issue of measurements. Under IFRS 9, key terms. Well, you can't run away from that, can you? Amortized costs, the amount at which the financial or financial liability is measured at an initial recognition minus the principal repayments plus or minus the cumulative amortization using the effective interest method of any difference between that initial amount and the maturity amount for financial assets adjusted for any loss allowance. Closing balance, this is my simple way of looking at amortized cost. If you want to find the closing balance of a financial instrument, whether it be a financial asset or a financial liability, what do? You say opening balance plus the effective interest rate less nominal interest. In most cases, this is what you'll be required to do in your exams. This is what you'll be required to do in your exams. Effective interest rate. What is it? This is the rate that exactly discounts estimated future cash payments or receipts through the expected life of the financial asset or liability to the gross carrying amount of a financial asset or liability cost of a financial liability. All right. Key terms: continued, held for trading. When is a financial instrument held for trading? A financial instrument is held for trading if it is acquired or incurred principally for the purpose of selling or repurchase in the near future. All right, let us progress. Financial guarantee contract. Financial guarantee is a contract that requires the issuer to make specified payments to reimburse the holder for a loss it incurs because the specified debtor fails to make payments when due in accordance with the original or modified terms of the debt instruments. Now, I thought about an example here. A parent company, for instance, may commit to take responsibility for the subsidiary's loan in the event that the subsidiary cannot meet its obligation. In this case, the parent company is called the guarantor. All right. Now, the issues of measurement rules, I want you to read through these at your own specific time. And without wasting too much time, allow me to go and show you some workings so that we are on the same page. Evidence from previous past papers shows that this is the most examined part of the topic, measurements of financial instruments. So you do yourself a favor by, appreciating how financial instruments are measured. So we'll start with what we call amortized costs. And let's start with fair value measurement. All right, fair value measurement. There's just a simple illustration before us. So say fair value of a debt on initial recognition. If, for instance, a director receives 5,000 interest-free loan over a payment will be made at the end of a 3-year period. How do we calculate the fair value of this financial instrument? Simple. All you need to do is to discount the 5 million using simple discount factor, of course, and of course you use what we call year 3 discount factor. So I hope that you can see this working here that has been given to you, so that now the fair value of this particular financial instrument will be 445. All right, let us go to another illustration which deals with amortized cost, and this is revision from your previous class. Amortized costs required. Show the amortized cost of the loan notes. I went straight, of course, to the question there. We're told a company purchases loan notes, nominal value 100,000. The purchase price is 96,394. 1st January X3, incurring transaction costs of 350. The loan notes carry interest paid annually of 4% of nominal value, meaning that if you apply the 4% on the 100,000, you'll be getting 4,000. The loan notes will be redeemed at par when on 31st December 20X5. The effective interest rate in this case is 5.2%. Let us do this work, and I want to just say that this is measurement of financial instruments. This is a 3-year working. Why? Because I think, as you saw from the question, the acquisition of these loan notes took place on 1st January 20X3. We're supposed to report. On 31st December. We're supposed to go all the way, rather. 31st December 20X5. So this is not supposed to be very difficult. Let me just show you. Let's drag this the other side. What do we have here? Dollars. Right. Dollars. And I think I'll drag this as well. I don't have to relent. Alright, this is not supposed to be. Alright, so brought forward or starting figure, we can call this opening balance. For the first year, of course, we are dealing with, as the question has given us guidance, 96,394 there. 96,394 plus the issue costs of 350. If I may If I may add that, what do I have? 96,394 plus 350. You add effective interest rates, which will be based on 5 point, if I remember well, 5.2. So how am I doing this? Saying 96,744 multiplied by 5.2%. I think you can do this. Can we work that one? 96,744 by, that's what we have there. All right, that's correct. And then you say less what you pay, nominal interest or coupon rate. It's the same thing. So based on the nominal value of this particular debt instrument, multiply of course by 4%. Now I don't want to redo that because I think by now we were told already in the question that this will be 4,000. I'm going to replicate this throughout, and the closing balance at the end of the year will be the sum of the three items: opening balance plus effective interest minus nominal interest. On the other end, you need to remember that what you close with in the previous year is the opening balance for the current year. All right, and then we can still replicate this work as well. I don't think that we are going to have a big challenge. Again, also here, I'm just using the power of Excel. This should not be very difficult. Let me just pick that one and push it there. Okay, so there's a challenge with my, because he was supposed to have 100. There's a challenge with my interest for the second year. Let me do it again in basic terms. So say that is equal to that figure multiplied by, yes, that is a figure there. All right, let me also do the other one. This figure is equal to that figure multiplied by, yes, that's a figure there. So the whole idea was to make your balance at the end of year 5 100 equal to the nominal value. All right, so that's what we have. I would like us to make progress to the next question, which should be an assignment 2, so that nobody is left behind. You need some bit of explanations here. Remember this question, before I get away from it, this was an investment in debt. All right, so this is a financial asset. We bought a financial asset. We invested in debt. All right, in a debt instrument, of course. So what you will observe is that when you go to your profit or loss, these amounts which are falling under the effective interest should register as finance costs in the income statement. Please remember that. And these amounts which are closing balances should register as financial assets in the financial position. Now you have to be careful when you are here. Of course, we still have what we call a non-current asset, but when we come to the end of year 4, I think we'll be dealing with current asset, because it will only be 12 months to go for us to get back our money. I hope that you can see how that is progressing. I'd like us to now go ahead and deal with the next question, which is an assignment. What on a public limited company has requested your advice on accounting for the following financial instrument transaction. What is the requirement? Discuss with suitable calculations how the above financial instruments should be recognized in the financial statements. Nice question. All right. What on a public limited company has requested for your advice? A says that we're going to be taking one question at a time. On 1st January 20x on 1st January 20x1, Wharton made 10,000 interest-free loan to an employee to be paid back, all right, on 31st December. The market rate on an equivalent loan would have been 5%. How do we proceed? All right, how do we proceed with that? This is assignment 2, all right. Let us deal with that work and see if we can get somewhere. So take a pen, please, write the following. This is an investment in debt where the business model is to collect contractual cash flows. Such investments are to be measured at fair value. Since we have an interest-free loan, the cash paid will not be equal to the initial fair value. Therefore, the initial fair value should be discounted at market rate. So what we mean by that, please take note of these workings, for this is where your marks are coming from. Fair value of this particular interest-free loan made to an employee will be equal to how much did the employee receive? 10,000. Let me just get back to that, make sure that, all right, yes, that's correct. Then you multiply that by 1, all right, divided by brackets 1.05. 05, of course, is the discount factor, and then we say what we have to the power, how many years? 2. Remember that. Okay, I've got a challenge with my Excel on this. I will just give you the figure that I've calculated simply. How much is the figure that we have calculated? It's 9070. Please counter check that figure with your calculator. The loan should subsequently be measured at amortized cost. So initially we will use what? Fair value. This is called initial measurement. All right, initial measurement. And then we deal with now what we call the fair value. Subsequently, let's deal with subsequent measurements. Subsequent after initial recognition. How do we go about measuring this particular instrument? So we get that, pushing that amount. We deal with the opening balance. In this case will be the fair value that we've just calculated. Opening balance, that's the amount there, that's the figure that you have. What else do you have? You have got effective interest rates. That will be 9070 multiplied by 5%, of course. If you do your maths, again, this is a little bit simple for my Excel. I think I should be able to get that figure. And then what is the coupon rate? Nominal interest rate. It is actually 0. All right, it is actually 0. Can we do that at 0%? So we have got new there. Or you can always sum up, say what is the sum. That is the figure there. Now how do we proceed? Recognize these amounts in the statements. So for your extracts, please, and I'm going to make it a little bit simple. In your profit or loss, recognize interest income on this particular instrument of 454. What else do you have? You've got again, in your financial position, recognize a financial asset at the end of the year of that match. Right, I hope that is not difficult for us to remember. Let us make headways. And I think the next question that I'm going to do will be the last for now, since we don't need to make these videos very long. Rather, let us deal with the last portion of the question. It says, Wharton anticipates expenditure in the few years, capital expenditure in a few years, and therefore invests its excess cash into short-term and long-term financial assets so it can fund the expenditure when the need arises. Wharton will hold these assets to collect the contractual cash flows, and when an opportunity arises, the entity will sell financial assets to reinvest the cash in financial assets with a higher return. The managers responsible for this portfolio are remunerated on the overall return generated by the portfolio. As part of this policy, Wharton purchased 50,000 par value of loan notes at 10% discount on their issue on 1st January 20x1. The redemption date of these loan notes is 31st December 20x4. An interest coupon of 3% per annum, or 3% par value rather, is paid every year on 31st December. Transaction costs amounting to 450 were incurred on the purchase. The annual interest rate of return on the loan notes is 5.6%. At 31st December X1, due to a decrease in market interest rates, the fair value of these loan notes increased to 51. Nice question. Discuss receivable calculations. Again, discuss. So please pick a pen and write the following. The loan notes are investments in debt instrument, where the business model is to collect contractual cash flows and to sell the financial assets. So this particular loan note is being held for speculative purposes. The asset is to be measured, of course, at fair value plus transaction costs. All right, and then subsequently, of course, we can use what we call the amortized cost. But now notice that there was a revaluation of some kind that took place. So let's do the work. This is part B of that assignment. What do we have? Dollars. I would like to say fair value at, no, my computer does not have the at symbol on the right position. At 1st January X1, of course. What do we have? Get your 50,000. The question clearly states that there was a 10% discount, so we are dealing with 90% of 50,000. And then after you've done that, you add the issue cost of 450. If you do your work properly, you may discover that we are on the same page. This multiplied by 9 plus 450. I'm getting 84. Okay, is this supposed to be? Okay, I think there should be a challenge with my formula because it's supposed to be less than 50. All right, let me do it again. Equal sign, open brackets, 50,000 multiplied by 0.9 plus 450. That is the correct figure. All right, effective interest rate we normally add. Please remember that. Effective interest rate, which in this case will be 45,450 multiplied by 5.6%. What do you have? That is a figure there. Let us try to have that figure, and then less the coupon rate, which is the nominal interest rate, which is based on the 50,000, of course, multiplied by a 3%, which is so on the other side. All right, so again, this should not be very difficult. You have got 1.5 there. It's supposed to be a minus. Let me just put the symbol there so that we have the correct figures. Let's do the work. How much do you have? 495. All right, now we are told that at the end of the first year there was a revaluation of this particular instrument, and this was the amount that was involved. Can I get there? We are told in the last instance, due to a decrease in market interest rates, the fair value of these loan notes increased to 51,000. So what you need to do is to find whether there's a gain or a loss on the change. I think there is going to be some kind of a gain. There is going to be some kind of a gain of 4505. All right, so how do we proceed in the statements? Okay, so extracts. Again, remember this stage we need to be very good at application, and of course ability to explain the impact of this business transaction on the decision-making processes of key stakeholders. All right, recognize the 4505 dollars there as finance income in the statement of profit or loss. Okay, and then recognize how much is that? 51,000 as the financial asset in the statement of financial position. So thank you for taking time to listen to this recording. Next time again we pick it up from there. We shall do more work. We're still on measurement, by the way. Thank you so very much.